Hi, welcome to Investment Analysis and Portfolio Management course. The title of this module is Risk and Return. The section goal is to understand the fundamental of investment management, and the module goal is to understand the concept of risk and return. First, we're going to talk about risk. Risk is defined in financial terms as the chance that an outcome or investment actual gains will differ from an expected outcome or return. Risk includes the possibility of losing some or all of an original investment. Thus, risk is an uncertainty. Each investor has a unique risk profile that determines their willingness and ability to withstand risk. Remember, in previous chapter, we learned about investors are risk-averse. In general, as investment risks rise, investors expect higher returns to compensate for taking those risks. Some sources of investment risk include microeconomic fluctuations, changing fortunes of various industries, and firm-specific unexpected developments. Next, we discuss about return. Return is the net gain or loss of an investment over a specified time period, expressed as a percentage of the investment initial cost. When we invest, we defer current consumption in order to add to our wealth so that we can consume more in the future. Therefore, we talk about a return on an investment. We are concerned with the change in wealth resulting for this investment. This change in wealth can be either due to cash inflows, such as interest or dividends, or caused by a change in price of the asset, positive or negative. Thus, holding period return or realized rate of return is based on the price per share at year's end and any cash dividends collected. Another term is expected return. Why we call it expected return? Because it is the profit or loss that an investor anticipated on an investment that has known historical rates of return. Expected return is calculated by multiplying potential outcomes by the odds that they occur and totaling the results. Of course, calculating the expected returns of a specific investment or portfolio allows you to anticipate the profit or loss on that investment based on its historical performance. Then, we move to the concept of utility. In the field of economics, utility is a measure of how much benefit consumers derive from certain goods or services. So, in finance, utility is a function of wealth that measures the overall benefit or satisfactions derived from investing. We assume that all investors seek for maximize their utility. Utility is increasing in and has a positive slope and concave in wealth. Positive marginal utility occurs when the consumptions of an additional item increase the total utility. The shape of the utility function has a behavioral interpretation where concavity of utility implies risk-averse behavior and convexity implies risk-seeking behavior. Even though normally investors are risk-averse, but they can be classified into three groups: risk-averse, risk-neutral, and risk-seeking. So in this concept, risk-averse individuals shows increasing at a decreasing rate. On the other hand, risk-seeking individuals shows increasing at an increasing rate. Next, mean variance utility. Is an alternative approach is to define utility over investment performance. In particular, the investor portfolio mean and variance. The mean variance utility postulates that random variables with the same mean and variance should be equally desirable. Look at the formula. A is a measure of the investor risk aversion. Higher means that the investor is more risk averse. To measure bias for mean or return from investment, statistically, we use standard deviation and variance. Standard deviation is a statistic that measures the dispersion of a dataset relative to its mean and is calculated as the square root of variance. The standard deviation is calculated as the square root of variance by determining each data point's deviation relative to the mean. If data points are further from the mean, there is a higher deviation within dataset. Thus, the more spread out the data, the higher the standard deviations. For example, a volatile stock has a high standard deviation, while the deviation of a stable blue chip stock is usually rather low. The formula for standard deviation is calculated by taking the square root of a value derived from comparing data points to a collective mean of a population. A lower standard deviation isn't necessarily preferable. It is all depend on the investment and the investor willingness to assume the risk. Other important concept is the normal distributions. Normal distributions is a bell-shaped probability distributions. The normal distribution is a continuous probability distribution that is symmetrical around its mean. Most of the observations cluster around the central peak, and the probabilities for values farther away from the mean taper off equally in both directions. Many everyday datasets of natural phenomena typically follow a normal distributions. The graph of the normal distribution depends on two factors: the mean and the standard deviations. Investment management is more manageable when returns can be well approximated by the normal distribution. So, what if excess returns are not normally distributed? We should note that standard deviation is no longer a complete measure of risk. Thus, we need to consider skewness and courtsies. Skewness is a measure of symmetry, or more precisely, the lack of symmetry. A distribution or dataset is symmetric if it looks the same to the left and right of the center point. Courtsies is a measure of whether the data are heavy-tailed or light-tailed relative to a normal distributions. For an investor, high courtsies of the return distribution implies the investor will experience occasional extreme returns, either positive or negative, more extreme than the usual positive or negative 3 standard deviations from the mean that is predicted by the normal distributions of return. Finally, we discussed the risk and return on long-term investment. A long-term investment is an account a company plans to keep for at least a year, such as stock, bonds, real estate, and cash. By staying invested over the long term, some years are low or negative returns, and some years of impressive returns will make the average returns quite reasonable. Although it takes a very long time, and in terms of risks, it is relatively higher, the return that will be obtained is also much greater than short-term investment. Okay, we have a quiz for this material. If a portfolio of common stock had a return of 20%, and the risk-free asset returns was 7%, and the standard deviation of the portfolio excess return was 34%, the risk premium would be and A, 10% and can be negative, B, 13% and cannot be zero, for investor would be unwilling to invest in common stocks and must always be positive in theory, C, 49% and can be negative, and D, 12% and must always be positive in theory. So this is the end of this module. See you later.